Part 1. The Setup. If you are holding physical silver right now, whether it is in your hand, sitting in your safe, stored with a dealer, or locked away in a private vault, you need to understand something very important. You may be standing directly in the middle of one of the most intense liquidity battles the silver market has seen in years. Not next quarter, not someday in the future, right now. And the question I want you to keep in the back of your mind as we go through this entire breakdown is simple. Why would the largest banks and commodity desks in the world benefit from ordinary silver holders selling their metal before the market opens on Monday? I am not going to fully answer that question yet, because to understand the answer, you need the full picture. You need to see what happened in the vaults. You need to understand what is happening in Asia. You need to understand why institutional analysts are suddenly using price targets that would have sounded ridiculous just a year or two ago. And most importantly, you need to understand why the paper price of silver and the real-world physical market may be sending two very different signals. Part 2. The $70 price and the shift. As of Friday's close, silver is trading around $70 per ounce on the spot market. To the average person watching mainstream financial media, that sounds expensive. They hear $70 silver and assume the move has already happened. They assume it is too late. They assume silver has run too far, too fast. But that is exactly where most people may be missing the real story. Because in the current macro environment, with industrial demand rising,
this is not just about chart patterns. This is not just about sentiment. This is about physical supply, institutional positioning, and whether the price being quoted on Western exchanges is still accurately reflecting the true marginal demand for real metal. The most important data point from Friday's session was not the closing price. It was what happened inside COMEX registered silver inventories. According to the numbers being discussed across the commodity market, registered silver inventories declined by approximately 23 million ounces in a single Friday session. 23 million ounces. That is not a small move. That is not something serious investors should casually ignore. Part 4. Registered versus eligible and market friction. And it is especially important because we are talking about registered silver, not just eligible silver. Here is the difference. Eligible silver is metal sitting inside approved COMEX vaults, but it has not been formally made available for delivery against futures contracts. Registered silver is different. Registered silver is the pile that is certified deliverable and available to meet futures delivery demands. So when registered inventory drops sharply, that matters. It tells us something about the pressure inside the physical delivery system. It tells us that real metal, not just paper contracts, is becoming central to the story. A 23 million ounce registered drawdown represents a meaningful share of annual global mine production moving out of the deliverable category in a single session. Now, could some of that be reclassification? Yes. Could some of it be administrative movement? Yes. But when you combine a large single session drawdown with weeks of persistent inventory pressure, rising global demand, and widening international premiums, it becomes much harder to dismiss the entire move as routine bookkeeping. Part 5. The disconnect and the paper market. And here is what makes it even more interesting. While this was happening, most of the mainstream financial press was focused on geopolitical headlines, Federal Reserve commentary, and broad market noise. Very few outlets led with the COMEX silver drain. Very few connected it to the larger structure of the market. And that disconnect between what the data is showing and what the mainstream narrative is covering is exactly where risk and opportunity can appear. Now, ask yourself this. If 23 million ounces of registered silver just moved out of the deliverable pile, why did the spot price not explode higher immediately? That is the key question. And the answer tells us a lot about how the modern silver market actually works. Because silver is not only traded as a physical commodity, it is also traded through a massive paper market, made up of futures, options, derivatives, swaps, and institutional positioning. In the short term, the paper market can overpower the physical signal. It can delay the repricing. It can absorb panic. It can create the appearance of stability. But that does not mean the physical signal disappears. It just means pressure continues building beneath the surface. Part 6. mine disruption, and inelastic supply. Now, let's add the next piece. Reports have been circulating about a serious disruption tied to a major silver producing operation connected to Glencore's activity in Kazakhstan. Early numbers being discussed suggest that millions of ounces of future silver output could be affected. I want to be careful here because early commodity disruption reports can change as more official information becomes available. But the broader point is this: in a market already dealing with tight physical supply, even a moderate disruption can have an outsized impact. Silver supply is not like turning on a faucet. You cannot simply raise prices and instantly produce more silver. Mine development takes years. Permitting takes years. New production takes years. And most silver does not even come from primary silver mines. A large percentage of global silver supply is produced as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is often tied to the economics of other metals. If copper or zinc production decisions change, silver supply can be affected, even if silver demand is exploding. This is one of the most misunderstood parts of the silver market. People say higher prices will bring more supply, and eventually that is true. But eventually can mean years. It does not mean Monday morning. It does not mean next month. It does not mean supply suddenly appears the moment a chart breaks out. Part 7. The $300 target and the Shanghai premium. So, if physical demand is rising now, then supply cannot respond quickly. But pressure has to show up somewhere. It can show up in premiums, it can show up in vault drawdowns, it can show up in delivery stress, it can show up in sudden price gaps. And sometimes it shows up in all of those places at once. That brings us to Bank of America. This week, Bank of America's commodity research has been widely discussed because of a silver price target that would have sounded outrageous not long ago: $300 per ounce. Before anyone gets carried away, let me be very clear. A price target is not a prophecy. It does not mean silver goes to $300 next week. It does not mean a straight line higher. It does not mean there will not be violent corrections along the way. A major bank price target is a modeled scenario based on assumptions. The important question is not whether the exact number is guaranteed. The important question is, what changed in the model to make that number worth publishing at all? The assumptions appear to center around several major forces. First, accelerating industrial demand from solar, electrification, and energy infrastructure. Second, structural deficits in physical supply. Third, declining above-ground inventories. Fourth, currency and hard asset dynamics as investors continue reassessing the long-term role of fiat currencies, reserve assets, and real commodities. Whether you agree with $300 or not, the existence of that kind of institutional research matters because it signals that silver is no longer being treated as a fringe asset. It is being taken seriously by major institutions managing serious capital. And once institutional research changes, institutional positioning can follow. That does not happen all at once. It does not always show up cleanly on the first headline, but over time, when major research desks begin modeling dramatically higher prices, portfolio managers, hedge funds, family offices, and commodity desks start asking different questions. They start stress testing different outcomes. They start treating upside scenarios as something that must be planned for, not laughed off. But the most important signal right now may not be coming from Wall Street. It may be coming from Shanghai. As of Friday's data, silver in Shanghai has reportedly been trading at a significant premium to Western spot prices, with estimates around 13%. Let me put that in simple terms. If Western silver is trading around $70, a 13% premium implies a local price closer to $84 or $85. That is not a tiny difference. That is not normal noise. Premiums between regions can happen because of taxes, shipping, currency conversion, and local supply-demand conditions. A small premium is normal. A 13% premium is a message. Normally, arbitrage should close that gap. Traders should buy silver where it is cheaper, move it to where it is more expensive, and profit from the spread. That process should push Western prices up, Eastern prices down, and the premium should narrow. But for arbitrage to work, traders need available physical metal and the ability to move it efficiently. If physical silver is tight, if vault supply is constrained, if logistics are stressed, and if cross-border metal movement is becoming more complicated, then the arbitrage mechanism slows down. And when that happens, the premium becomes more than a pricing oddity. It becomes a warning signal. The Shanghai premium is telling us that the marginal physical buyer in one of the world's most important commodity markets is willing to pay more than the Western quoted price. That means the Western paper price may not be fully reflecting real physical demand. And when a market has two prices, one on a screen and one in the real world, eventually, one of them has to adjust. Part 8. Retail reality and the counterargument. Now, let's talk about retail silver holders, because this is where the story becomes personal. Across North America, Europe, and Australia, many retail investors are reporting tighter availability at local dealers. Certain coins, bars, rounds, and mint products are becoming harder to find for immediate delivery. Some products are backordered, some dealers are quoting meaningful premiums over spot. And the question retail buyers are asking is obvious. Are dealers actually out of stock? Or are some of them holding inventory back because they expect higher prices? I want you to tell me what you are seeing. If you believe dealers are sitting on product and waiting for better prices, type hold in the comments. If you believe the shelves are genuinely empty and supply is truly tight, type empty in the comments. I want to know what is happening.
To close this out, here is the bottom line. Silver is entering one of the most important moments we have seen in years. A major COMEX-registered inventory drain, reported production disruption concerns, institutional price target revisions, a major Shanghai premium, and growing stress in physical availability are all pointing toward the same conclusion. The silver market is changing. It may not move in a straight line. There will be volatility, there will be pullbacks, there will be fear, hype, confusion, and noise. But underneath all of that, the structural story is becoming harder to ignore.